Well, hello, guys. It's Danny Deals coming at you once again with another exciting episode of Un Poco Mas, the show where we give you just a little bit more on behalf of executive producer Hurricane Lopez and supervising producer Stop Karen. We would like to welcome you to the program. Today is May 22nd, 2023. It's after market about 1:45 p.m. out here on the West Coast. That's about 4:45 out in NYC. Hope it's a great evening, afternoon, day, night, wherever you happen to be in this beautiful world that we all share. Let's get right into it, guys. The Carvana stock. This was a darling of the run up, the COVID run up when everyone was staying at home and Zoom was $1 million a share. And Tattooed Chef was going to be the next $1 trillion market cap. Well, here we had Carvana. A company that combined used car dealerships and big glass towers to park the cars in, and that was sort of their unique selling point if you get right down to it. They don't really have a unique selling point. What everyone tries to say, it's the same thing, you know, pets.com and all the other internet companies want to say is they're using machine learning and algorithms to become more efficient, and it's just baloney. The reason this stock soared was that their sales went up massively during COVID and they spent a ton of money on advertising and customer acquisition. And even during that period where their business absolutely soared through the roof, kind of artificially, they never really made any cash flow. They never made positive cash flow. They never made dollar one. This entire business has never made dollar one. There's a massive, massive short on it for a reason. And everybody says, okay, we've come off of $4. We found support up around, $8. Now we're sitting at $11.47 after running up 73 cents or 6.8% today. But the volume was very moderate at 13 million shares. And let's just be clear, 4 million shares were returned. So shorts are loosening their grip on the stock to some degree, and 4 million shares were returned today out of only 13 million that traded. So that accounts for more than that 7% increase. So there is no new money coming into the stock today. If you look at the 7-day action, the estimated short interest of the float has gone from 64.2 to 63.9, almost none. Um, the percentage of the free float on loan has gone from all the way up at 78 down to 75. Shares on loan 59 million to 56 million. Days to cover 36 to 35. Cost to borrow 11.6 to 11.3. Utilization at 100%. And what you have to worry about if you're looking for a short squeeze is this cost to borrow. Um, if this were truly at 100% utilization and shares were that scarce, cost to borrow max would be a hell of a lot more than 13%. I'm seeing stocks where that percentage is as high as, almost 200% routinely. So some of this data can be a little bit confusing, a little bit hard to follow. But the bottom line is this: Carvana just had to extend its offer for its debt swaps. It's giving more incentives, and the debt on Carvana is not sustainable. If you look down here, there was a headline on that they actually had to put out a wire 5 days ago. Carvana announces extension of private exchange offers, withdrawal deadline, and early exchange premium. They're basically saying, hey, we're going to push this out from mid May to June 1st. And if you read like this table of incentives here, they're basically saying that, these are the levels of debt you have to have. This is the priority level. This is the exchange consideration. And this is the early exchange premium. So for every $1,000 that they're agreeing to extend, whoever's making that agreement is getting anywhere between $858 and $632 of consider total extra consideration in order to push out their debt. So this is not good. This is like anybody agreeing to do this, they're having to do this. They clearly have no choice. So why would you add all this extra debt? Not even, I understand they're trying to reduce the interest rates and they're trying to reduce their interest expense quarterly. So, they can make the numbers look better, but they're just saddling themselves with even more debt. Taking a look at this story over in the Motley Fool, and you know the Motley Fool puts out a lot of content. Some is better, some is worse, some is just sort of AI generated garbage. But this is by Brett Schaefer. I noticed my forehead is extra shiny. That's a bonus for you guys tuning in. And we have a Toper time check today. Toper time check, 1:51 p.m. That's 9 minutes to the top of the hour, 51 minutes from the bottom of the hour. Toper time check is 1:51 p.m. Pacific Standard Time. Is Carvana stock ready to make a comeback? This is by Brett Schaefer, May 22nd, 2023. And Brett's thinking is a lot in line with mine. Yes, there's a huge short on the stock. We all acknowledge that. We all realize if there's some coordinated action on behalf of the bulls, that could lead to a short squeeze. But I would argue that it will be temporary because those same folks will dump the stock once it goes up. This won't be another, AMC. This won't be one of those situations where the hedge funds get burned hard. They're looking for that. They're hedging, so they see all that stuff coming. There's not going to be another GameStop type situation here. Listen, Carvana's Q1 earnings, more cash burn. First quarter 23 wasn't great for Carvana. Revenue declined 25% year over year to 2.6. Gross profit increased 14% to 341 million as the company was able to earn a better margin on each vehicle sold. This helped Carvana's quarterly operating loss improve from 506 million to 288 million in the first 3 months of 2023. While still unprofitable, the stock jumped after the company released these financial results in early May, indicating that his investors were expecting a higher operating loss in that period. So Carvana investors have very, very low expectations if they consider that a win. The biggest problem for Carvana has always been cash flow, not once since going public, as the company generated positive free cash flow, burning 1.12 billion over the last 12 months. Bulls might argue that free cash flow burn has been greatly reduced compared to prior years, which is true, but there's still lots of progress to be made for the company to achieve a stable financial situation. Revenues keep declining. If revenues keep declining, it's hard to see how the company can get there despite its recent improvement in gross margins. Management is guiding for gross margins in the second quarter, doing expense reductions, but retail units sold are still forecast to decline from 2022. Also, you can go through and read this yourself, but there's more pain in used car prices. Used car prices are going to go down another 15% by the end of the year. You just have to look at the Manheim Used Vehicle Value Index, and you can see that it's coming down sharply since the pandemic high there. So it's down from 250 down below like 225 right now. So that's a reduction of like 10%. And it's just going to continue to go down. So, and in 2022, used car prices started to decline with supply chain issues leading Carvana's cash flow and overall profitability taking a hit. However, leading automotive lender and large Carvana partner Ally Financial project used car prices will decline by more than 15% end of 2023. You can already start to see this happening. That means Carvana will once again go from a macroeconomic tailwind to a macroeconomic headwind. Call me crazy, but this doesn't sound like a great economic environment for Carvana to try to reach positive cash flow. Can Carvana survive? The answer to that question is no. No one's going to keep financing this company, burning money with sales reducing, and they're not making any money. And I just don't see. There's really nothing that innovative about this company. Whenever I hear what's the unique selling point, what's the special sauce, and I hear like AI, machine learning, algorithms. I'm like, okay, but explain to me how all that knowledge and all that data is going to actually lead to them cornering more of the used car market and making more per car. You say, okay, their margins are increasing a little. That's just because they're forcing that. They have less units. They're spending less on advertising. But the company is still not healthy. The company is still buried under a huge, huge amount of debt. Listen to this. Let's also consider the company's balance sheet, because why would you want to look at a balance sheet before you invest in a company? Just buy whatever because it's in the news and because they have big glass vending machines, that sell cars. What are you, a child? What is this, the claw game where you go in and get a car? This company's garbage. It's garbage. At the end of the first quarter, Carvana had 488 million cash on hand on its balance sheet with 1.7 billion in short-term debt. 1.7 billion in short-term debt and 6.55 billion in long-term debt. Just in the first quarter, it had to pay 160 million in net interest expenses. 160 million in net interest expenses in the first quarter. Look at that as a percentage of their entire revenues. It's a joke, folks. This company mismanaged badly when they had a lot of money coming in. They could have dialed things back on the advertising, customer acquisition, actually made a net profit and paid down some of this debt. But they chose that hyper growth forever mode where we never actually have to make any money and we just grow and raise money and finance and interest rates are always going to be low and everything's going to be rosy. So let's just get out there and spend, spend, spend. Because for God's sakes, why would our shareholders want us to actually make any money when all these fruitcakes can just sit at home and engineer this imaginary short squeeze where they all want to get rich quick? Ain't gonna happen, folks. This company is garbage. They have never made any money. They're not gonna make any money. And the only short squeeze you're gonna see is in your trousers, folks. Second, it's tough to see Carvana start growing again since it's pulled back aggressively on marketing spend to try and improve its profit margin. There you go. You're saying, okay, their margins are up, but their sales are down. See, any company can spend and spend and spend and acquire customers, and they can spend and spend and spend and sell because each sale you make, you're losing money because it's costing you so damn much to sell that product. Your margins don't make up for it. That's what we call a garbage company. It's a fugazi. It's basically a scam. And third, it's unlikely that cash flow is going to flip to positive over the trailing 12-month period. The company might squeak out positive cash flow for a quarter or two due to projected declines in used car prices. Not a great situation to be in. And here's the kicker. Carvana has never had a profitable business model, and unless its unit economics drastically change within the next few quarters, it never will. Hint, their unit economics aren't drastically changing. This company still sells used cars. You idiots. Okay. And the company is likely going to run out of cash or heavily dilute existing shareholders within the next few quarters, making the stock one to avoid for investors right now. There are plenty otherwise better run businesses to invest your money in. Folks, don't buy Carvana. Could it short squeeze? Yes, it could short squeeze if the stars align and there's a lot of buying pressure for whatever reason in one day and you time it and you dump it right, you could make a lot of money. But that is no way to invest. It's no way to live because all of that money you're going to make in that short squeeze will not help you when you've had a massive heart attack and you're writhing down on the floor and you're like, I'm going to get rich. And then you croak and you die, and your ungrateful, horrible children end up inheriting all that short squeeze money. Is that what you want? No. What you want to do is invest in something sensible, like an index fund or a bond, because you're an idiot and you don't know what to do. If your investment thesis is, let's find a horrible company that has a high short interest so we could get a short squeeze. Please, folks, please. Wall Street bets, diamond hands, it's all fun to talk about, but Carvana is a massive, massive pile of crap and a huge, huge turd. I hate the stock. Don't buy it. Short squeeze or not, I can't tell you. All I can tell you is this company is not going to survive in its present iteration with its present business model. It's going south in a big, big hurry. Management is holding on to bilk it for all they can, and you turds are along for the ride. Thank you for watching Un Poco Mas. My name is Danny Deals. On behalf of Hurricane Lopez, we'll talk to you again real soon. Have a great day. Don't buy Carvana, you big turd.